Imagine waking up one morning and discovering that physical money has almost disappeared. No coins in your pocket, no banknotes in your wallet, maybe no traditional bank account at all. You receive your salary digitally. You pay for your coffee with your face. Artificial intelligence manages your savings. Money moves across countries in seconds. Governments create their own digital currencies, and new forms of money appear that didn't even exist 20 years ago. This may sound like science fiction, but parts of this future are already beginning. And that raises a fascinating question. What will money actually look like 20 years from now? Will cash disappear? Will banks still control our money? Will cryptocurrencies become part of everyday life? Will artificial intelligence decide how we save, spend, and invest? And perhaps the biggest question, will the future of money give ordinary people more freedom or more control over their lives? Hello, my amazing students, and welcome again to your channel. My name is Clara, and today we're going to explore the fascinating future of money, how technology is changing the way we earn, spend, save, and transfer value, and what these changes could mean for ordinary people around the world. We'll look beyond simple predictions. We'll explore digital payments, cryptocurrencies, government-backed digital currencies, artificial intelligence, the changing role of banks, and why the meaning of money itself may be entering one of the biggest transformations in modern history. At the same time, you'll improve your English listening skills, build useful vocabulary, strengthen your speaking confidence, and improve your overall English fluency through this fascinating economics lesson. And stay with me until the end, because the future of money isn't only about technology. It's about power, privacy, opportunity, and who may control the financial world of tomorrow. So let's begin. For thousands of years, money was something you could touch. Coins, gold, silver, paper banknotes. If you wanted to buy something, you physically handed money to another person. If you wanted to save money, you kept it somewhere safe. And if you lost your wallet, you probably lost your money too. But today, something extraordinary is happening. Money is becoming invisible. Think about the last few things you bought. Did you use cash? Maybe you tapped your card, used your phone, paid online, sent money through an app. In many situations, no physical money changed hands at all. Just numbers moving from one account to another. And this transformation is happening faster than many people realize. Now here's something fascinating. For younger generations, physical cash is already becoming less important. Many people receive their salaries digitally, pay their bills online, order food through apps, buy products from websites, send money to friends instantly. They can live for days, sometimes weeks, without touching a single banknote. So, naturally, a question appears. Are we moving toward a cashless world? The answer is complicated. Cash probably won't disappear everywhere at the same time. Different countries have different economies, different technologies, different levels of access to banking, and different attitudes toward privacy. But the direction is clear. Digital payments are becoming a larger part of everyday economic life. Now think about why. The first reason is convenience. Imagine buying something in a store. You don't need to count coins. You don't need to wait for change. You simply tap your card or phone. The transaction is completed in seconds. Now imagine sending money to someone who lives hundreds of kilometers away. Years ago, that process could be slow. Today, in some countries, it can happen almost instantly. Technology has changed people's expectations. We want payments to be faster, simpler, available 24 hours a day. And businesses want the same thing. But convenience isn't the whole story. Digital money creates something physical cash cannot easily create: data. When you pay with cash, the transaction can leave relatively little digital information. But when you pay electronically, information can be recorded: where the transaction happened, when it happened, how much you spent, sometimes even what you purchased. And that data can be extremely valuable. Banks can use financial data to detect fraud. Businesses can use payment information to understand customer behavior. Technology companies can use data to improve financial services. Governments may use financial records to investigate illegal activity. But this creates a serious question. Who should have access to information about how you spend your money? Because as money becomes more digital, privacy becomes more important. Imagine a world where every purchase you make creates a permanent digital record. Every coffee, every train ticket, every subscription, every donation, every payment. Would that make society safer? Or would it give institutions too much information about ordinary people's lives? There is no simple answer. And that's why the future of money is not only a technological question. It's also a social and political one. Now here's another important issue. What happens when the technology stops working? Imagine entering a store during a major internet outage. Your phone doesn't connect. The payment system is unavailable. Your card doesn't work. But you have no cash. Suddenly, the convenience of digital payments becomes a weakness. Cash has one major advantage. It can work without electricity, without an internet connection, without a battery, without permission from a digital platform. That's why some experts believe cash may continue playing an important role, even in highly digital economies. Not because it's more advanced, because it provides an alternative. Now let's think about another challenge: financial inclusion. Billions of people around the world have gained access to digital financial services. In some regions, people who never had traditional bank accounts can now send and receive money using mobile phones. That's an extraordinary development. A small business owner can receive payments digitally. A worker can send money to family members. A person living far from a bank can still participate in the financial system. Technology can make money more accessible, but it can also create new barriers. What about elderly people who struggle with technology? What about people without smartphones? What about communities with unreliable internet access? What about people who cannot easily open bank accounts? If physical cash disappears too quickly, some people could be left behind. And that's an important lesson. Technological progress doesn't automatically benefit everyone equally. The way technology is introduced matters. Now here's something else most people don't think about. Money is built on trust. A banknote is simply a piece of paper. A number inside your banking application is simply digital information. You accept both because you trust the system behind them. You trust that other people will accept the money. You trust that the bank will protect your account. You trust that the currency will still have value tomorrow. Without trust, money stops working. And as money becomes more digital, the institutions we trust may begin changing. Today, most people rely on commercial banks and payment companies. Tomorrow, they may use government digital currencies, cryptocurrency networks, technology platforms, or financial systems we haven't invented yet. And each system will ask us to place our trust somewhere different. That's why the disappearance of cash is much bigger than changing how we pay. It changes who sees our transactions, who controls the payment systems, who has access to financial services, and what happens when the system fails. Now imagine the future. You walk into a store. There is no cashier, no physical card, no banknotes. Technology recognizes you. The payment happens automatically. You leave. Fast. Efficient. almost invisible. That future could be incredibly convenient, but convenience always comes with questions. What happens to your data? Can you still pay privately? Can someone block your access to the financial system? What happens during a technological failure? And who controls the infrastructure behind your money? These questions will become more important as physical cash becomes less common. Because the future of money isn't simply about replacing paper with screens. It's about redesigning one of the most important systems in human civilization. And the next transformation could be even bigger. Because governments around the world are exploring something that may completely change the relationship between citizens, banks, and money itself. Central Bank Digital Currencies. Chapter 2. Central Bank Digital Currencies, or CBDCs. At first, the idea sounds simple. Money is already digital. We already pay with cards. We already transfer money online. We already see numbers inside banking applications. So what would actually be different? The difference is much bigger than it appears. The digital money in your bank account today is generally a claim on a commercial bank. A central bank digital currency would be digital money issued directly by a country's central bank. In other words, digital cash created by the state. And that could change the financial system in ways we're only beginning to understand. Now imagine receiving money directly into a digital wallet. You use it to buy food, pay your bills, send money to another person. The transaction could happen quickly, perhaps instantly. And depending on how the system is designed, you might not need a traditional bank to complete the payment. Think about what that could mean. For hundreds of years, commercial banks have played a central role in our financial lives. They hold deposits, process payments, provide loans, connect people to the financial system. But what happens when citizens can hold digital money connected more directly to the central bank? Would traditional banks become less important? Would they need to completely change their business models? These are questions economists and governments are already studying. Now, here's one reason central banks are interested in digital currencies. The way people pay is changing. Physical cash is being used less frequently in some countries. Private payment companies are becoming more powerful. Cryptocurrencies and stablecoins have introduced alternative ways to transfer value. Central banks don't want to lose their role in the future of money, so they're exploring how public money can survive in a digital world. Now imagine a future where almost every payment happens through private technology companies. Those companies could control enormous financial networks. They could collect huge amounts of data. They could influence who can access financial services. And if one company became dominant, millions of people could become dependent on its infrastructure. A central bank digital currency could provide a public alternative. Money issued by the central bank, but designed for the digital economy. Now here's where things become interesting. CBDCs could make payments faster, especially international payments. Today, sending money from one country to another can involve multiple banks, fees, currency conversions, waiting periods. Sometimes, the process takes days. In the future, new digital currency systems could potentially make some cross-border payments faster and cheaper. Imagine a worker living abroad. Every month, they send money to their family. Today, fees may take part of that money. The transfer may take time. A more efficient digital system could allow more of the money to reach the family faster. That's a significant benefit. Now let's talk about financial inclusion. Millions of people still have limited access to traditional banking services. Some live far from bank branches. Others cannot afford certain fees. Some don't have the documents or financial history required to access traditional services. A carefully designed digital currency could potentially give more people access to basic payments. A digital wallet, a phone, the ability to receive money, save, pay, participate in the economy. But here's the problem. Technology can solve one barrier while creating another. What happens to people without smartphones, without reliable internet, without digital skills? A financial system cannot truly be inclusive if millions of people cannot use it. That's why the design of these systems matters enormously. Now we arrive at one of the biggest debates surrounding CBDCs: privacy. Imagine paying with physical cash. You walk into a store, buy something, hand over money, leave. In many cases, no central database automatically records your identity and transaction. Now imagine paying with a central bank digital currency. The transaction happens electronically. Depending on how the system is designed, information about that payment may exist somewhere. Who can see it? The central bank? Commercial banks? Payment providers? Government agencies? And under what circumstances? These questions are extremely important because financial privacy is closely connected to personal freedom. Your spending habits reveal a surprising amount about your life: where you travel, what organizations you support, what you buy, who you send money to, what services you use. Financial data can create a detailed picture of a person. So any digital currency system must answer a difficult question. How can society prevent crime and protect the financial system without creating unnecessary surveillance? There is no universal answer. Different countries may design their digital currencies differently. Some may prioritize privacy, others may prioritize security and control, and those choices could shape the relationship between governments and citizens for generations. Now, here's another controversial possibility: programmable money. Imagine money that can follow certain rules. A government sends emergency financial assistance that can only be used for specific purposes. A payment expires after a certain date to encourage spending. Taxes are collected automatically during transactions. Certain payments are restricted by law. Technically, digital money could make some of these systems possible. Supporters might argue that programmable features could make public programs more efficient. Critics might argue that they could give institutions too much control over how people use money. Again, the technology itself isn't automatically good or bad. The rules surrounding it matter. Now, imagine waking up one morning. Your country has introduced a digital currency. You download an official wallet. Your salary arrives digitally. You pay taxes, buy products, send money, receive payments. Everything happens inside a new financial infrastructure. At first, your daily life may not feel very different. But underneath the surface, the structure of money has changed. The relationship between you and commercial banks may be different. The role of the central bank may be different. The level of privacy may be different. The speed of payments may be different. Even the government's ability to respond to economic crises may change. That's why central bank digital currencies deserve attention. Not because they're guaranteed to replace cash, not because every country will adopt the same system, and not because they will automatically create a better financial world, but because they represent something much bigger. Governments are preparing for a future where money itself becomes digital infrastructure. And whoever designs that infrastructure will make decisions about privacy, access, security, freedom, and power. But governments aren't the only ones trying to reinvent money. Outside the traditional financial system, another experiment has been growing for years. An experiment built around the idea that money might exist without being controlled by a central bank at all. And that brings us to cryptocurrencies. Chapter 3: Cryptocurrency. Few financial ideas have created so much excitement, confusion, hope, and controversy. Some people believe cryptocurrencies will transform the global financial system. Others believe they're primarily speculative assets that will never replace traditional money. Some people have made fortunes from them. Others have lost enormous amounts of money. So what is cryptocurrency really? The future of money? Or one of the largest financial experiments in modern history? To understand that question, we need to understand why cryptocurrency was created in the first place. For most of modern history, money has depended on trusted institutions. Central banks issue currencies. Commercial banks hold deposits. Payment companies process transactions. Governments create financial regulations. When you send money to another person, you usually depend on one or more intermediaries: a bank, a payment processor, a financial platform. Cryptocurrency introduced a radically different idea. What if people could transfer digital value directly, without depending on a traditional financial institution to maintain the system? That idea became famous with Bitcoin. In 2009, Bitcoin began operating as a decentralized digital currency. There was no central bank issuing new Bitcoins. No single company controlled the network. Instead, transactions were recorded on a distributed digital ledger called a blockchain. Now imagine a giant record book. Thousands of computers around the world maintain copies of that record. When transactions happen, the network follows rules to verify and record them. Changing the historical record becomes extremely difficult because no single institution controls the entire system. That's the basic idea, and it was revolutionary. For the first time, people could imagine a form of digital money that didn't depend entirely on governments or traditional banks. Now here's where things become interesting. Bitcoin has a limited maximum supply. According to its protocol, no more than 21 million Bitcoins can ever be created. Supporters believe this scarcity is one of Bitcoin's greatest strengths. Traditional currencies can increase in supply when central banks create more money. Bitcoin follows predetermined rules. That has led some people to describe it as digital gold, an asset that could potentially store value over long periods of time. But here's the problem. Money needs more than scarcity. It also needs stability. Imagine receiving your salary today, then discovering its purchasing power has fallen significantly next month. Imagine selling a product, but the value of the payment changes dramatically before you can use it. That volatility makes many cryptocurrencies difficult to use as ordinary everyday money. And that's one reason most people still pay for groceries, rent, and bills using traditional currencies. Now, here's another challenge: speed and cost. Some cryptocurrency networks can process transactions quickly. Others can become slower or more expensive when many people use them at the same time. Developers are constantly working on new technologies to solve these problems, but creating a financial network that is secure, fast, affordable, decentralized, and capable of serving billions of people is extremely difficult. Now let's talk about one of the most attractive ideas behind cryptocurrency: financial freedom. Imagine someone living in a country with an unstable financial system. Banks may be unreliable. Inflation may be high. Moving money internationally may be difficult. Access to certain financial services may be limited. Cryptocurrency can potentially offer another option. A person with an internet connection may be able to access digital financial networks without opening a traditional bank account. That possibility is powerful, but freedom comes with responsibility. If someone forgets a traditional bank password, the bank may help recover access. If a cryptocurrency owner loses certain private credentials, their funds may become permanently inaccessible. If they send money to the wrong address, there may be no institution capable of reversing the transaction. In decentralized systems, you may gain more control, but you may also carry more responsibility. Now here's something else that changed the conversation. Stablecoins. Stablecoins are digital tokens designed to maintain a relatively stable value, often by connecting their value to traditional currencies, such as the US dollar. Why is that important? Because they combine certain advantages of cryptocurrency technology with the relative stability of traditional money. Imagine sending digital dollars across the internet, potentially at any time, across borders, without relying on the same traditional payment infrastructure. For some people and businesses, that can be extremely useful, and stablecoins have become an important part of the digital asset economy. But they also create new questions. Who holds the assets supporting those stablecoins? Can users trust the company issuing them? What happens if everyone wants to exchange their tokens for traditional money at the same time? How should governments regulate them? Once again, the future of money becomes a question of trust. Now, let's discuss something that cannot be ignored: speculation. Millions of people became interested in cryptocurrency not because they wanted to reinvent the financial system, but because they wanted to make money. Prices increased rapidly. Social media created excitement. People feared missing opportunities. Some invested without understanding what they were buying. Then markets fell. Projects collapsed. Companies failed. People lost money. This revealed an important truth. New technology can create real innovation and dangerous speculation at the same time. The existence of one doesn't eliminate the other. Now imagine the early internet. Thousands of companies appeared. Investors became excited. Money flowed into businesses with ambitious ideas. Then the dot-com bubble collapsed. Many companies disappeared. But the internet didn't disappear. The technology continued developing. Years later, it transformed almost every industry. Could cryptocurrency follow a similar path? Possibly. Many projects may fail. Some technologies may disappear. But certain ideas could survive and become part of the future financial system. Nobody knows exactly which ones, and that's why we should avoid two extreme predictions. The first is that cryptocurrency will completely destroy traditional banking. The second is that cryptocurrency has no value and will completely disappear. Reality may be somewhere in between. Traditional banks could adopt blockchain technology. Governments could regulate digital assets. Stablecoins could become more widely used for certain payments. Bitcoin could remain primarily a digital asset rather than everyday currency. New systems could appear that we haven't imagined yet. The future will probably be more complicated than one technology replacing another. Now here's the deeper question. What problem does cryptocurrency solve? For some people, it's protection from unreliable financial institutions. For others, it's easier international payments. For others, it's ownership of digital assets. For investors, it's a speculative opportunity. And for developers, it's an experiment in building financial systems differently. Different people see different value, and that makes cryptocurrency difficult to describe with one simple sentence. But one thing is clear: cryptocurrency forced the world to reconsider what money can be. Can money exist without a government? Can financial systems operate without traditional banks? Can digital scarcity create value? Can people truly control their own assets? And how much financial responsibility are ordinary people prepared to carry? These questions will continue shaping the future of money. Because the biggest impact of cryptocurrency may not be that everyone eventually pays with Bitcoin. Its biggest impact may be that it forced governments, banks, technology companies, and billions of ordinary people to imagine that money itself could be redesigned. And now, another force is entering this transformation. A technology capable of analyzing enormous amounts of financial data, predicting behavior, automating decisions, detecting fraud, and managing money faster than any human being. Artificial Intelligence. Chapter 4. Artificial intelligence is already changing the world. It can write, analyze data, recognize images, translate languages, detect patterns, and solve problems that once required hours of human work. But one of the biggest transformations may happen somewhere much closer to your daily life: your money. Imagine waking up in the morning, and before you've even had breakfast, your AI financial assistant has already analyzed your spending, moved extra money into savings, found a subscription you no longer use, compared your electricity bill with cheaper alternatives, detected an unusual transaction, and adjusted your monthly budget. All without you doing anything. This may sound futuristic, but the financial world is already moving in this direction. Banks and financial companies have used algorithms for years. They analyze transactions, detect fraud, evaluate risk, make lending decisions, and study customer behavior. Artificial intelligence could make these systems even more powerful, more personal, more automatic, and perhaps more influential over our financial lives. Now here's something fascinating. For most of history, managing money required active decisions. You decided how much to save. You created a budget. You compared financial products. You researched investments. You watched your spending. But many people don't do these things consistently. Not because they don't care about their future, because financial decisions require time, knowledge, attention, and discipline. AI could change that. Imagine an intelligent system that understands your financial behavior. It knows how much you earn, how much you usually spend, which bills arrive every month, what your financial goals are, and how your situation changes over time. Instead of giving everyone the same financial advice, it could give personalized guidance. It might say, "You're spending more on food delivery this month. Your emergency savings are below your target. You have enough money available to increase your savings slightly. This bill is unusually high compared with previous months." Suddenly, financial advice becomes available every day, not only to wealthy people who can afford professional financial advisors, but potentially to millions of ordinary people. And that could be one of AI's greatest financial benefits: access. Now imagine a young worker receiving their first salary. They know almost nothing about managing money. Nobody taught them how to create a budget, how to build emergency savings, how to understand debt, or how to plan for long-term financial goals. An AI assistant could explain these concepts in simple language, answer questions, help them understand their spending, and warn them before small financial mistakes become large problems. That could improve financial education dramatically. But there's another side to this story. For AI to give highly personalized financial advice, it needs data. A lot of data. Your salary, your purchases, your debts, your savings, your location, perhaps even your online behavior. The more information the system has, the more accurately it may understand you. But that creates a serious question. How much of your financial life are you willing to give an algorithm permission to see? Now imagine an AI system that knows you better than you know yourself. It notices that you usually spend more money when you're stressed. It knows when you receive your salary. It predicts which advertisements are most likely to influence you. It understands your financial weaknesses. That information could be used to help you, or it could be used to sell you more things. And that's where the future becomes complicated. The same technology that can protect consumers can also influence them. Imagine opening a shopping application. The AI knows exactly which product you're most likely to buy. It knows the best time to show it to you, the perfect price, the perfect message, the perfect payment plan. You may believe you're making an independent decision, but the system may have predicted your behavior before you even clicked the button. Now here's something important. The future of money will not only depend on who controls currencies, it may also depend on who controls financial algorithms. Because algorithms increasingly influence which products people see, which loans they receive, which transactions are considered suspicious, which investments are recommended, and how financial risk is calculated. These decisions can have enormous consequences. Now let's talk about lending. Today, when someone applies for a loan, banks evaluate risk. They look at income, debt, credit history, employment, and other financial information. AI systems can analyze much larger amounts of data, potentially identifying patterns humans would never notice. Supporters believe this could make lending decisions faster and more accurate. It could potentially help people who have limited traditional credit histories. But what happens when an AI rejects someone's loan application? Can the person understand why? Can they challenge the decision? What happens if the algorithm learned from biased historical data? A faster decision isn't automatically a fairer decision. And as AI becomes more powerful, transparency will become increasingly important. Now let's move to investing. For generations, investing required research, financial advisors, market analysis, experience. Today, automated investment platforms already help people manage portfolios. Artificial intelligence could take this much further. Imagine a system analyzing economic data, company reports, market trends, news, consumer behavior, and thousands of other signals simultaneously. It could react faster than any human investor. Adjust portfolios automatically, manage risk, search for opportunities. But here's the problem. If millions of AI systems react to the same information at the same time, financial markets could behave in unexpected ways. Automated systems could potentially increase market instability during periods of panic. A mistake could spread quickly. Speed creates opportunity, but speed can also create risk. Now here's another fascinating possibility. AI may change how people earn money. Some jobs will become more productive. Others will change dramatically. New jobs will appear. Certain tasks may disappear. People may work with AI systems instead of competing directly against them. And that could change salaries, business models, education, and the value of different skills. Imagine a small business owner with access to AI tools. They can analyze customers, create marketing materials, communicate in multiple languages, automate administrative work, and make better financial decisions. Tasks that once required an entire team may become possible for one person. That could create extraordinary opportunities. But it could also create greater inequality between people who know how to use these tools and people who don't. Now here's the deeper question. Will artificial intelligence make ordinary people better at managing money? Or will it make people more dependent on systems they don't understand? Imagine allowing an AI to manage your entire financial life, your savings, your spending, your investments, your financial decisions. Everything works perfectly for years. Then one day, the system makes a mistake. Would you notice? Would you understand what happened? Would you know how to take control again? Convenience can slowly reduce knowledge. When technology handles everything for us, we may stop learning how the system works, and that could become dangerous. The smartest future may not be one where AI completely controls our money. It may be one where AI helps us make better decisions, while humans remain informed and responsible. Because technology should increase our abilities, not replace our understanding. Now imagine your financial life 10 years from today. Your AI assistant analyzes your finances, warns you about risks, helps you save, explains complex decisions, protects you from fraud, and gives you access to financial knowledge that once required expensive experts. That could be an extraordinary future, but only if the system respects privacy, provides transparency, reduces unfair bias, protects users, and keeps humans in control of important decisions. Because money is not simply numbers. Money represents time, work, choices, security, freedom, and opportunity. Any technology powerful enough to influence our money is powerful enough to influence our lives. And that brings us to the biggest question of this entire episode. If cash becomes less important, governments create digital currencies, cryptocurrencies challenge traditional financial systems, and artificial intelligence begins managing our financial decisions, who will actually control the money of the future? Governments? Banks? Technology companies? Decentralized networks? Artificial intelligence? Or ordinary people themselves? Chapter 5. After everything we've explored, one question remains more important than all the others. Who will control the future of money? Governments? Central banks? Commercial banks? Technology companies? Cryptocurrency networks? Artificial intelligence? Or ordinary people? The answer will shape much more than how we pay for things. It could shape privacy, freedom, opportunity, economic power, and the relationship between individuals and some of the most powerful institutions in the world. Now imagine the financial world 20 years from today. Cash is used less frequently. Digital payments happen instantly. Artificial intelligence manages parts of your financial life. Digital currencies move across borders. Banks have changed. New financial platforms have appeared. And billions of people interact with money through systems that don't even exist today. That future could be incredibly efficient, but efficiency alone doesn't guarantee fairness. And that's one of the most important lessons we need to understand. A financial system can be fast and still exclude people. It can be technologically advanced and still reduce privacy. It can be convenient and still concentrate enormous power in the hands of a few institutions. So the real question isn't simply, what technology will we use? The better question is, what kind of financial system are we building? Now let's think about governments. Governments already have enormous influence over money. They create laws, collect taxes, regulate banks, manage economic policies. And through central banks, they influence the supply and cost of money. Digital currencies could potentially increase their ability to operate financial systems more efficiently. Payments could become faster. Government assistance could reach people more quickly. Tax systems could become more efficient. Financial crime could become easier to investigate. Those are real possibilities. But greater technological power also creates greater responsibility. Because if a government has the technical ability to observe more financial activity, restrict certain transactions, or create detailed records of how citizens use money, then strong protections become extremely important. Technology can increase efficiency, but institutions still need accountability. Now let's think about banks. For generations, banks have stood between individuals and much of the financial system. They hold deposits, provide loans, process payments, help businesses grow, and connect people to financial markets. But the future may challenge that position. Digital currencies could create new payment systems. Financial technology companies could offer services that once required banks. Artificial intelligence could automate financial advice. Decentralized networks could allow some transactions to happen without traditional intermediaries. Does that mean banks will disappear? Probably not, but they may have to evolve. History shows us something important. Old institutions rarely disappear simply because new technology arrives. They adapt. They acquire new technology. They change their services. They compete. and sometimes they become even more powerful. Now imagine a future bank. You rarely visit a physical branch. An AI assistant answers your financial questions. Algorithms analyze your risk. Payments happen instantly. Financial products are personalized to your behavior. The bank knows more about your financial habits than ever before. That could create better services. But once again, the question becomes data. Who owns your financial information? Who can use it? Can you move it to another platform? Can you delete it? Can companies sell insights about your behavior? The future of money will also be a battle over financial data. Now, let's think about technology companies. Some technology platforms already connect billions of people. They know what we search for, what we watch, where we go, who we communicate with, what we buy. Now, imagine those same companies becoming central parts of the financial system. They could combine social data, behavioral data, location data, and financial data. That would create an extraordinary amount of information about individuals, perhaps more than any institution has ever possessed in human history. And data creates power. The more accurately a company can understand your behavior, the more effectively it can predict your decisions, recommend products, set prices, evaluate risk, and influence what you do next. That's why the future of money cannot be discussed without discussing privacy. Now, let's turn to cryptocurrencies and decentralized finance. Their original promise was very different. Instead of trusting powerful institutions, trust the network. Trust the code. Trust transparent rules. Give individuals greater control over their assets. Reduce dependence on intermediaries. For some people, this represents financial freedom. But decentralization creates its own challenges. Who protects users from fraud? Who fixes mistakes? Who takes responsibility when systems fail? How do ordinary people evaluate complex technology? Freedom without understanding can create new forms of risk. And that's why the future probably won't be as simple as centralized systems versus decentralized systems. We may see combinations of both. Governments using blockchain technology, banks offering digital assets, cryptocurrency companies becoming regulated financial institutions, decentralized networks connecting with traditional markets. The boundaries may become increasingly difficult to see. Now, here's something important. Most ordinary people will not control which technologies become dominant. You probably won't decide whether your country introduces a central bank digital currency. You won't control how artificial intelligence transforms banking. You won't decide which financial platforms become globally powerful. But that doesn't mean you're powerless, because one of the greatest advantages you can have in a changing financial world is understanding. Understanding how money works, understanding debt, inflation, saving, investing, risk, technology, privacy, and the incentives of the institutions managing your money. Financial literacy may become more important in the future, not less, because the more complicated the financial system becomes, the more dangerous it is to use it without understanding it. Now imagine two people living in the same future. Both have access to the same technology, the same digital payments, the same AI tools, the same financial platforms. The first person accepts every recommendation without asking questions. They don't understand the fees, the risks, the data they're sharing, or how the system works. The second person uses the same technology but remains curious. They read, learn, compare, ask questions, protect their information, understand basic financial principles. Who is more prepared? Almost certainly the second person, because technology changes, Financial principles often remain surprisingly stable. Spend less than you earn. Be careful with debt. Understand risk before investing. Avoid promises of guaranteed wealth. Protect yourself from fraud. Build financial knowledge. Think long-term. And never give control of something important to a system you don't understand at all. Now, here's another important lesson. Don't confuse new technology with guaranteed progress. A new financial system isn't automatically better because it's digital. A cryptocurrency isn't automatically valuable because it uses blockchain. An AI recommendation isn't automatically correct because it was produced by an advanced model. A government system isn't automatically dangerous because it uses digital technology. We need something more valuable than excitement or fear. We need critical thinking, the ability to ask good questions. Who benefits from this system? Who carries the risk? Who controls the data? What happens if the technology fails? Can I leave the system? Can I challenge a decision? Do I understand what I'm agreeing to? Those questions may become some of the most important financial questions of the future. Now let's return to the beginning of this episode. We imagined waking up in a world where physical money had almost disappeared. Your salary arrived digitally. Artificial intelligence managed your finances. Governments issued digital currencies. New forms of money moved around the world. That future may sound distant, but financial transformation is already happening. The real challenge isn't predicting exactly what money will look like. Nobody can do that perfectly. The real challenge is preparing ourselves for change, learning, adapting, paying attention, protecting our privacy, understanding risk, and becoming more financially educated. Because the future of money won't only be created by economists, bankers, governments, programmers, or technology companies. It will also be shaped by the choices billions of ordinary people make every day. What systems they trust, what technologies they adopt, what freedoms they protect, and what questions they're willing to ask. So perhaps the most important question isn't, what will money become? Perhaps it's, what kind of relationship will we choose to have with money when technology can understand, move, and control it more easily than ever before? The future of money will be faster, more digital, more intelligent, and probably more complicated. But no matter how advanced technology becomes, one principle will remain essential. The more powerful our financial systems become, the more important it becomes for ordinary people to understand them. Because money has never been only about buying things. Money represents choices, time, work, security, opportunity, independence, and power. The technology may change. The form of money may change. The institutions may change. But understanding how those changes affect your life may become one of the most valuable skills you can develop for the future.